Well, thank you. The problem is it's kind of difficult to have any kind of a coherent big picture view that you can have a lot of confidence in, because the potential for disruption is so large, even if it's just a head fake or two for a couple weeks or a month. And that's a function of the way that Trump, rolls. I mean, and we saw that in the first administration. He obviously has learned some things about how DC works, and is going about it a little differently in this administration, or a fair bit differently. But as it pertains to economic and financial matters, he's kind of using the same rules, which are, it's kind of impossible to predict what he might do next. And so you've got this mix of that volatility combined with the sort of the uncertainty about what's going to happen at the Fed. When I say that, I mean, it's pretty clear the next person who's chosen is going to be an easy money type. And so that means we're probably on the cusp of lower rates. Whether we should have lower rates or not, we could discuss, but that's probably what's going to happen. So you've kind of got that carrot dangling. The economy has been stronger than people would have guessed, largely because of a lot of the size of the budget deficit going into the economy. But some of that's been disrupted via Doge. But nevertheless, unemployment has held, or employment or unemployment have held in at pretty steady levels. The BLS's job creation number is not accurate because it's mostly a function of the birth-death model, which makes assumptions which may or may not be true. So I'm saying this because it's difficult to have a strong opinion about how things may change. We're kind of in this kind of slow growth state with a lot of things changing, inflation threatening to flare up. We've got this massive budget deficit, which is no longer being talked about because of, I think, Besant's decision to roll the financing to the short end of the curve. Then they've allowed banks to up their leverage ratio, and banks like to buy at the short end of the curve. And then he's going to try to get a Fed chairman in there to cut rates. So what the big story is, what they're trying to do, although they haven't articulated it like this, is get as much financing done at the short end and create as much pressure as possible, as many incentives as possible to induce buyers into that part of the curve. That's why they changed the bank leverage ratio, right? And I read somewhere from a credible person that might unleash $3 trillion worth of basically bank carry trades. So that's a decent number, even given the size of our deficit. So the sort of supply and demand mismatch in the bond market has been sort of negated by maneuvers by Besant for the time being. Now, if we start to sniff lower short-term rates, that may have an impact on the dollar, which has been a bit on the weaker side. But the problem with the dollar being weak is weak against what? Because other currencies, governments behind the other currencies have similar problems. So we're pursuing policies that would normally probably argue for a weaker currency, but other countries are pursuing the same sorts of policies. The sort of supply and demand mismatch in the bond market has been sort of negated by maneuvers by Besant for the time being. Now, if we start to sniff lower short-term rates, that may have an impact on the dollar, which has been a bit on the weaker side. But the problem with the dollar being weak is weak against what? Because other currencies, governments behind the other currencies have similar problems. So we're pursuing policies that would normally probably argue for a weaker currency, but other countries are pursuing the same sorts of policies. So that's one of the reasons why gold has done so well. And as pertains to stock market, there's really nothing to say because the passive bid continues to dominate. that and all the structured, mechanical, reverse engineered flows that come in behind that, which I know Mike Green's explained this on your show. I'm pretty sure you've had him on at least once.
Yes, a couple times. Yeah.
And so you've got this force holding the stock market up, all things being equal, unless the news gets ugly enough that can swamp that bid, which we saw a little bit of that last April. But in the absence of that, it chugs along. The economy's kind of in a status quo state with a certain amount of uncertainty. And beneath the surface, the employment isn't as strong as it looks, particularly, I think, for college kids. So it's kind of a muddle through kind of a mix. But of course, you wouldn't think that if you looked at where the stock market was hitting new highs. But of course, that has nothing to do with reality because it's dominated by the passive robot. So that's kind of the stage. I don't have any really strong conclusions. For a number of times when we spoke before, I was thinking about, or I was short bonds. I covered them in front of the election just because I didn't know what Trump would do. Net, the bond market hasn't really gone very far one way or the other. They're playing these games. Whether or not they get away with them, we'll have to see. I think in the end, the bond market's going to be weaker, or the yield curve will get very steep, and the currency will get weaker. But again, against what? And so I think the only idea that you could have a high degree of confidence in is to have exposure to precious metals, which I've talked about probably every time you've had me on. I continue to feel like that's some sort of you have to have. It's mandatory to have some exposure to gold and or silver. It's what I think.
Mm-hmm. I feel like that's still a great frame up to the conversation, and even a continuation of our conversation last time. And there are a lot of kind of uncertainties and maybe games being played and forces at play that are propping things up. But as you kind of point out, it's a bit of like a muddle through time. From an investor perspective, though, as someone who's been in markets, I don't know, for like 40 plus years, right?
Right.
What do you do?
Well, I made the determination, probably December, January, having seen how Trump operates and the potential for a lot of volatility and uncertainty and given valuations and all the risks and things, I decided that I would hold more cash than usual. So I've kept my exposure to precious metals the same. I reduced my exposure to mining. I've tried to find individual companies that have certain characteristics whereby they could grow through any sort of a stagflationary weak economy because of whatever their basic business is. And so I've looked for a few kind of rifle shot sorts of ideas. But I think the antidote to all this craziness is carry more cash. Although that seems like a bad idea right now with the market hitting new highs, and precious metals. Obviously, Warren Buffett is carrying the most cash he's ever had for some reason. He hasn't really articulated exactly why, and we'll find out after he starts spending it again. But so I think sometimes sometimes it just pays to have less risk. And you may go months and months and months where it seems like that was a bad idea, and then all of a sudden in a 2-week period, you're really glad you did. Like for instance, last April. It's entirely possible we could have another setback like that. But again, the news has to get disruptive enough to overcome the passive flows, and then when you start working to the downside, things can just open up. I mean, we were just a couple of ticks away from a halt in the NASDAQ futures there in mid-April, which could have gone anywhere in the short run. So I think when the risks are this high and the valuations are this high, even though the valuations don't matter to the passive bid, I think it's prudent just to carry more cash, just to have less risk and more flexibility. When I was running my short fund from 95 to 2008, there were sometimes I would go all to cash, but that was different. That was pretty much because I thought the market was going to be up and I didn't want to have any shorts. It's a little different. I mean, other than when I ran my short fund, yes, this is the most cash I've held.
Do you still short?
Well, I have nothing against it, except that it doesn't work. That it doesn't work very well because of the the passive bid, which is like a tractor beam hauling the stock market higher, and these other factors make it very difficult to get shorts to work. And then a lot of times what happens is, like, for instance, last night Texas Instruments had light guidance, stocks down I'll call it 12% today. I've traded it on the short side a few times in the last few years. But what happens to these ideas is they kind of go like that, like where if you short them, you kind of